You know what really gets under my skin? You work your whole life, you pay your taxes, you do everything right. And then you finally hit 65, you start getting your old age security check, and the government says, actually, we're going to need some of that back. Yeah, they take it back, quietly, every single month. And most folks don't even realize it's happening until it's too late. It's called the OAS Clawback, and in 2026, it's hitting more Canadians than ever before. Today, I'm going to break down exactly how this clawback works, show you the exact income number where it kicks in, and most importantly, I'm going to walk you through 5 simple strategies to protect your pension. Legal, legit, stuff your financial advisor probably hasn't told you yet. Stick around, because number 4 is the one that surprises most people. All right, let's start with the basics, because I've talked to a lot of folks who've been getting OAS for years and had no clue this even existed. So here's the deal. Old age security is a monthly payment from the federal government. Most Canadians who've lived here for at least 10 years after turning 18 qualify for it at age 65. You don't even need to have worked. It's not like CPP where you pay into it. OAS comes from general tax money. Right now, the maximum you can get is about $742 a month if you're between 65 and 74. If you're 75 or older, it bumps up to about $816 a month because of that 10% boost they added back in 2022. Sounds great, right? Free money every month. But here's the catch nobody talks about at the hockey rink. If your income is too high, I'm not talking millionaire money here, the government starts clawing it back. They call it the OAS Pension Recovery Tax. But let's be real, eh? It's a clawback, plain and simple. For every dollar you earn above the threshold, they take back 15 cents of your OAS. And if you make enough, they take the whole thing, every single penny. Now here's where it gets real. Let me give you the actual numbers for 2026. The clawback kicks in when your net income crosses $93,454. That's for your 2025 income, which affects your OAS payments from July 2026 to June 2027. And looking ahead to the 2026 income year, that threshold goes up slightly to about $95,323. Now you might be thinking, Ross, $93,000? That's a lot of money. I'm probably fine. But hold on, think about this for a second. Let's say you've got CPP coming in, maybe $15,000 a year. You've got a workplace pension, another $35,000. Your RRIF is spitting out mandatory withdrawals. That's maybe $25,000. Plus your OAS itself, which counts as income. And maybe you sold some stocks or a piece of property this year. Add all that up and, buddy, you're over $93,000 before you even realized it. And here's the kicker. Once your income hits roughly $152,000, your entire OAS is gone. Zero! The government takes back every dollar. That's close to $9,000 a year, just poof, disappeared. But wait, there's something even sneakier most people miss. The clawback works on a 1-year delay. Your 2025 income determines what happens to your OAS starting July 2026. So that big RRSP withdrawal you made last year, it's coming back to haunt you this summer. All right, this is the part you came for. Let's talk about how to fight back. And I mean legally. These are strategies financial planners use for their high-paying clients, but there's no reason you can't use them too. Strategy 1, the TFSA Shield. This one is huge, and it's probably the most powerful tool you've got. Here's the thing about your TFSA. When you take money out of it, the government doesn't count it as income. Not for taxes, not for OAS, not for anything. So let's say you need $20,000 this year for a new roof or a trip out west. If you pull that from your RRIF, boom, it gets added to your income and pushes you closer to the clawback. But if you pull it from your TFSA, your income stays the same. Your OAS stays untouched. The 2026 TFSA limit is $7,000. And if you've been eligible since 2009 and never put a dime in, you've got $95,000 of room. That's a lot of tax-free money you could be using to protect your OAS. Even if you're already retired, start putting whatever you can into that TFSA. Future you is going to say thank you.
Strategy 2. Pension income splitting. This one's for couples, and it's beautiful in its simplicity. If you're married or common law, and one of you earns way more than the other, you can split up to 50% of your eligible pension income with your lower income spouse. So let's say you're pulling in $110 grand, and your spouse is at 40. You're deep in clawback territory. But if you shift $25,000 of your pension income over to your spouse's return, now you're at $85,000, below the threshold, full OAS saved.
The eligible income includes RRIF withdrawals if you're 65 or older and workplace pension payments. CPP has its own sharing rules. That's a whole other video. Strategy 3. The RRSP meltdown. Okay, now this one takes a bit of planning, but it can save you tens of thousands over your retirement. Here's the problem. You've been a good saver your whole life. You've got a big fat RRSP, maybe $800,000, maybe over $1 million. When you turn 71, you have to convert that to a RRIF. And every year after that, the government forces you to take out a minimum amount. At 71, that's 5.28% of your balance, and it goes up every year. $1 million RRIF at 71 means you're forced to pull out $52,800. Add CPP and OAS on top, you're way over the clawback line. The meltdown strategy is this. Start pulling money out of your RRSP earlier, in your late 50s or 60s, when your income is lower. Maybe you've retired early or you're working part-time. You withdraw $30,000 or $40,000 a year from your RRSP, pay a modest tax on it, and then put whatever you can into your TFSA. By the time you hit 71, your RRIF balance is smaller, your forced withdrawals are smaller, and your OAS stays safe. It's like draining water out of a bathtub slowly, instead of waiting for it to overflow all over the floor. Strategy 4? Watch out for dividend gross-ups. This is the one that catches people off guard, and I see it all the time. You might think, I'll just invest in good Canadian dividend stocks. The tax credit makes them efficient. And yeah, the dividend tax credit is nice, but here's what nobody tells you. The CRA grosses up your dividend income by 38% when calculating your net income. So if you received $10,000 in eligible dividends, the CRA counts it as $13,800 on your tax return. That extra $3,800 of phantom income, it counts toward the OAS clawback threshold. You never actually receive that money, but it pushes your income up anyway. If you're near the clawback zone, consider holding dividend-paying investments inside your TFSA instead. Or look at capital gains, where only 50% of the gain counts as income. Way more clawback friendly. Strategy 5. Delay your OAS to 70. Last one. And this isn't for everyone, but if you've got enough income to cover your expenses between 65 and 70, delaying your OAS can be a smart play. For every month you delay past 65, your OAS goes up by 0.6%. That adds up to a 36% permanent increase if you wait until 70. So instead of $742 a month, you'd get over $1,000 a month for life. And here's the extra benefit. During those 5 years from 65 to 70, you're not receiving OAS at all, so there's nothing to claw back. Meanwhile, you can use those years to draw down your RRSP, shift money into your TFSA, and set yourself up so that when you finally start OAS at 70, your income is low enough to keep the whole thing.
The break-even age is somewhere around 82 or 83. If you think you'll live past that, and most Canadians do, delaying is a winning move. Before I wrap up, let me tell you the single biggest mistake people make with the clawback. They don't plan for it until it's already happening. You get that letter from Service Canada saying your OAS is being reduced, and by then, it's based on last year's income. It's already done. You can't go back in time and unwithdraw that RRSP money. The clawback isn't something you deal with at 65. It's something you plan for at 55, maybe even 50. The earlier you start thinking about your income mix in retirement, the more OAS you keep. And listen, I know this stuff can feel overwhelming. That's exactly why I started this channel. My name's Ross, and I'm building Retired Canadian to be different from what's already out there. No fancy jargon, no trying to sell you financial products. Just a regular guy from Canada breaking down retirement money in plain English, so you can actually make better decisions.
This is only our second video, and I'm planning to cover everything. CPP timing, RRIF strategies, GIS, provincial benefits, all of it. So if that sounds useful, you know what to do. Now, I'm curious about something. Drop a comment below and tell me, where in Canada are you watching this from? And have you been hit by the OAS clawback? I want to hear your story. I'll see you in the next one.